Tesla, everybody looks at Tesla and says, that's not possible. The R&D that these large auto companies are spending in the electric vehicle space swamps anything that Tesla could possibly do. Well, that misses the point that those R&D departments didn't get it right. They are still working with prismatic batteries. Tesla is riding down the cost curve of the consumer electronics industry, small batteries.
So you've talked about inefficiencies in both portfolio management and research. Can you elaborate a little bit on that?
Yes. What has happened in the last 30, 35 years is we've become much more specialized and siloed, certainly on the research side. So when I started in the business, maybe one analyst did all of industrials. Now you'll have 5 to 10 analysts picking apart the various spaces within industrials. That's what they focus on. And they focus very deeply into these companies and industries, and they're very focused on this quarter and next quarter. We are focused on disruptive innovation that cuts across economic sectors. Because there's so much of a siloing activity that's taken place because of how our industry has evolved, if a disruptive innovation is cutting across sectors, the odds are we are going to find it before these analysts do. We are looking for it. So we think that the inefficiencies in the business are disruptive innovation is not priced correctly because people don't understand how big the ultimate opportunities are going to be. They're not sizing the opportunity. They're not analyzing the disruption.
So 100 PE frightens them.
100 PE, they wouldn't touch it. And of course, we will have 100 PE stocks. We were talking about Athena. Athena's in both our genomic revolution theme and in our WebEx.0 theme. And that
so
is
that
at 100.
touches on how the problem of trying to analyze some of these companies.
Yes, they fall through the cracks. Is this a technology stock or is it a healthcare stock? It's both. Healthcare analysts don't want to follow technology stocks. Those are too high octane for them, right? The healthcare analysts are used to a highly regulated industry. And technology analysts don't want to follow a healthcare stock because it's too regulated, the government's too much in the way. So you get these combinations like this, and people don't know how to price them, right? So Athena is at 100 times earnings. And the reason is the opportunity it has in front of it, being the electronic healthcare record company and revenue lifecycle management company and connector of patients, hospitals, insurance companies, and doctors. It is a huge opportunity that could be winner takes most. And
well, that's one of the points you make, is that
yes,
if you're a leader on the leading edge and leading the charge, unlike the old adage, pioneers take the arrows.
yes,
You say they become the lions, they eat it all.
yes, they can. If they're the visionary, I mean, that was true of Intel, it was true of Microsoft, Google, Facebook. I think it could be true of Athena. Tesla, everybody looks at Tesla and says, that's not possible. The R&D that these large auto companies are spending in the electric vehicle space swamps anything that Tesla could possibly do. Well, that misses the point that those R&D departments didn't get it right. They are still working with prismatic batteries. Tesla is riding down the cost curve of the consumer electronics industry, small batteries.
Why don't you do pre-IPO stocks?
Oh, why don't we? Well, we think that's a very crowded space. The traditional asset managers have all moved into there trying to get closer to private equity. So what's interesting about that is we think a lot of the inefficiencies have been squeezed out there. Those stocks go public, they fall. You'll notice whether it's Facebook or LinkedIn or Twitter, they all come out, they all fall to earth. Lending Club, all fall to earth We get to do more time to do more research and analysis, knowing they've been hyped, and we're able to pick our spots, right? What I think people are also missing, talk about inefficiencies, the opportunities that are being created today are trillion-dollar opportunities. I often say, I think that Amazon is a trillion-dollar stock. It's $240 billion right now. Jeff Bezos has said that Amazon Web Services will be bigger than the retail services at some point in the future. So right now, it's at a $7.5 billion run rate, Amazon Web Services. The retail is nearly $100 billion. That's a long way to go. What he doesn't tell you is this is going to be 4 to 5 times as profitable. So we're talking about a $240 billion cap company. I really believe Amazon owns infrastructure as a service. Others are trying to compete. Open source is trying to compete with OpenStack. There are probably going to be 2 players, but Amazon owns that space. This is a $1 trillion idea. I think people are missing that. And what they will, and you can talk about 100 PE. This is probably 200 PE. They've made very little money over the years because they've reinvested against these fantastic opportunities. And those companies who have not invested are not going to be the winners. The companies that have been invested, that have these enormous multiples seemingly right now, are going to be the winners. So where are they today? Banks, they're value stocks. But we think they're going to be disrupted in many ways. Inverted yield curves, we think, are not just a passing phenomenon. We think they're going to stay flat to inverted, which is really difficult for banks because of innovation. And you can go back to the 50 years ended in the Roaring 20s, and you will see that yield curves were inverted more than 60% of the time, on average 100 basis points. This is a killer for net interest margins, right? And that the steepest inversions occurred during periods of strongest growth. It's the opposite of the way people are thinking now. And the reason that is because with innovation comes very rapid unit growth, and we think growth is understated in the economy. We're still operating with industrial statistics when we're in the digital age. It doesn't make any sense. So we think that real growth is understated, and productivity as well. And we think that inflation is overstated. So we might already be in a deflationary period. So the short end of the curve is responding to unit growth, very strong. The long end of the curve is responding to inflation, very low. So it makes sense. Back then, the average short rate averaged, or the short rates averaged 4.9%, long rates 3.9%. And we do think if we're right about what's going on with innovation and the exponential growth opportunities ahead here, that those kinds of interest rates will return. So that will be negative for the bond markets, but it won't be a disaster.
So you see negative yields then being just happening for the next X amount of years, or do you do this innovation?
Flat to inverted, yes. I don't know. We have, back then, there was no Federal Reserve. The Federal Reserve didn't come into place until 1913. And there was little government intervention. So today there's a lot of government intervention, and especially on the monetary policy side. So it may not play out exactly the same as that, but we wouldn't be surprised to see much flatter and sometimes inverted, and maybe more than sometimes inverted over time.
I want to take a step back and talk.
Can I just, on the disruption of banks, it's not just the yield curve. It's companies like Square and PayPal that essentially are going to allow people to carry their banks around with them in their pockets through their cell phone. We've already seen mobile payments explode in China. They went from $1 trillion in 2014 to $26 trillion, 2 times their GDP in 2018. That's a 26-fold increase over 4 years. That's crazy. That's disintermediating the banking system in China. We think the same thing's going to happen in the developed markets, and that digital wallets will take the place of bank branches. And we see this with Venmo, and with Cash App. And these are networks that are going viral because of social networking. To give you a sense, Cash App, Square's Cash App, merchants use it. It's just entered Australia, by the way, and merchants can swipe the Square, swipe a credit card through the Square for payments, and payments will accumulate in the Cash App. And what Square's competitive advantage is to a bank is Square knows every second of the day how this merchant's business is doing, right? Because it sees every payment, and it's able to anticipate working capital needs, and it's able to anticipate maybe capital needs. Oh, and by the way, payroll processing, and then it's got consumers using it, right? And then these consumers the consumers are responding to Cash App Friday or Super Cash App Friday, when Square is giving away, maybe in conjunction, this did happen with Burger King, they'll repay $10,000 of school loans if the winner is chosen. I mean, if whomever is chosen. So of course everybody starts applying for the Cash App. They would like to have access to that opportunity. Same thing with Super Cash App Friday. They were giving away 1 Bitcoin. That's $10,000 these days. That caused another surge in Cash App applications. So their cost of customer acquisition is roughly $20, whereas a bank, to get one credit card customer, has to pay anywhere from $300 to $1,500. There's no comparison. It's going to be very difficult. And then, so you've got Square and Cash App and PayPal nipping at the bank's heels. You have Goldman Sachs, Marcus, their online banking solution, coming for the head of the banks, or the heart. They're offering 3% plus for online deposit accounts. They'll pay 3%, and banks are at 0.2 or 0.3 or wherever they are. Again, no comparison. Bricks and mortar, it takes a lot to sustain those. These are online, digital, much, much lower cost.